Okay, everybody, thanks for joining us today. My name is Tim Travis, Chief Investment Officer and CEO of TNT Capital Management. We're a registered investment advisor located in Southern California. And today we're going to talk about covered calls, how they work, and really how you can take advantage of them to grow your portfolio and enhance your income generation. So let's go ahead and get started. Firstly, investing in the financial markets involves risk. Options aren't suitable for all investors. Past performance is not indicative of future results, and this is for educational purposes only. Let's take a look at Citigroup. So on May 18th, the stock closed at $46.39 per share. And if you look at the tangible book value, which is kind of a proxy for liquidation value, that was 84.21 at the end of the first quarter of this year. So most recent numbers, and if you look through it, I mean, they've been growing their tangible book value. It's just really the valuation's gotten more and more compressed, especially after the banking crisis really reared its head in March of this year, and really hasn't subsided too substantially yet. We haven't seen a broad-based, lengthy rally in the bank since then. So the price to tangible book is 55%, just immensely cheap. The dividend yield is 4.4%. So what I like to do when I'm looking at a bank, particularly something like Citigroup, is I like to look at normalized earnings. And so currently under new management, Jane Fraser, the company is divesting several of its non-core operations. So the consumer bank in Mexico is the biggest part of that. And there's rumors that there's a deal that's basically concluded, but it hasn't been officially announced yet. I think that could be a positive catalyst for the stock, as it would open the door for some more buybacks. And buybacks are enormously accretive at this type of valuation. They've already divested several of their Asian assets, and so they're making really good headway there. They're trying to expand into wealth management. They after the global financial crisis, they had to offload Solomon Smith Barney, which was a great operation. They sold it to Morgan Stanley, and that's really helped Morgan Stanley become the leader in wealth management amongst the big banks. And so they're trying to, take advantage of their branches, take advantage of their customer relationships, and get back in that. So that's another part of the business plan. So ultimately, to make a long story short, we think that they should easily be able to get to about a 12% return on tangible capital within a couple of years, let's say. So that would be equivalent to earnings per share of $10.10 based on the current tangible book value. So if they buy back stock, that could go higher. I don't think that's an aggressive number. So that would equate to a normalized earnings yield of 21.78%, just enormous. So if they were to pay out all of their earnings as a cash dividend, the yield would be 21.78%. That's the inverse of a price to earnings ratio. If you look at what they've done, so over the trailing 12 months, they've earned $7.29 per share. So just using that, the earnings yields 15.71%. So, we believe this stock is worth $70 to $80 per share. It's crazy that it's trading this low. It really speaks to, the fear and the panic that's in the market currently. And we believe that Citi should be able to grow tangible book value by about 10% per annum adjusted for dividends. So I think this is the type of stock where, several years from now, it'll be like, why was it so cheap? And people will forget, that there's literally bank runs occurring, in some of these smaller, weaker regional banks. And it'll just be, the math is pretty obvious. So barring a total blow up, economic catastrophe, Citigroup should be a heck of a buy based on current valuation. So let's talk about how we could utilize covered calls to kind of make the trade even safer and to enhance the income. So what we're going to do is we're going to buy 100 shares of Citi at $46.39. And then we're going to sell one January 2024 expiration, so that's 246 days out, $55 call for $1.50. So every option contract is based on 100 shares, so $1.50 means $150 premium. So our target profit, assuming that Citigroup trades above 55, is $1,011, or 22.52%, 33.6% annualized on the maximum risk of $4,489. So a very, very attractive return, assuming it hits 55. And, a good question is, well, why are we selling the call at 55 if we think the stocks were 70 to 80? It's a good question, honestly. And we really wouldn't sell a $55 call here. It's more for example purposes. We've sold calls at 70, that sort of thing, but at 55, I think it's a little too low unless you own a lot of Citigroup and you kind of want to stagger your options. So maybe you have 55, 60, 65s, but this is just giving an example of how covered calls work. So once again, think of options. Options can seem complicated to folks. On a strategy as simple as covered calls, basically it's heads or tails. So heads, if the stock's above 55, you make that $1,011 of profit, plus you get the dividend, which is 4.4% per annum. And then your option would be exercised at 55, and then you sell the stock. So that's heads, okay? Now tails, if Citigroup expires below 55 at expiration, you're going to end up owning the stock at a break even of 44.89. So nothing's changed. You've collected your dividend, you've kept that $150 premium, and you still own the stock. So the break even of 44.89 gives you a 3.23% cushion before you take any loss. And then we would have all the upside or downside from there. And then what's great is we can do it all over again. Okay, so if we still want to sell a call, we can just duplicate it and do a similar trade, upon that option expiring. But this strategy, you can see it enhances the yield. I mean, so the dividend's 204 per year. You're not going to collect all of that dividend because this trade's only 246 days, but you'll collect a nice chunk. Plus, you're going to enhance that yield by nearly 50%. So we're getting, kind of high single digits yield, just cash flow yield based on the dividend and the covered call. And you're retaining, quite a bit of upside up to 55. So hopefully this is a good explainer on how covered calls can work and how they can be a part of your portfolio. You can do this on a variety of different stocks, of course. I think there's good value in Citigroup, and I think the combination of yield and premium is attractive. So that concludes